Right, so we want to continue with our discussions on principle of taxation, and the next thing we want to look at is the treatment of financial cost and financial gain. Now, this is one of the key areas in the exam hall that the examiner is going to be playing with you, and you've got to understand the principles that underline how this treatment is done. Now, when it comes to the treatment of financial cost and financial gain, you have to look at it from two sources. Number one, it is treated differently in the mining and oil exploration or by mining and oil exploration companies differently from how it is treated in normal traditional companies. Okay, and in the sense of dealing with financial cost and financial gain, this actually excludes interest expenses. Okay, this excludes interest expenses. So let me go through the principles with you here. Then we're going to crunch some numbers, look at some questions, and then we will see how we go about it. Now, it is very simple when it comes to the mining and oil exploration companies. Now, for mining and oil exploration companies, the law says that the financial cost must be used against the financial gain. Now, I want you to get this carefully. The financial cost must be used against the financial gain. What does that mean? It means that the financial cost allowable for a year under consideration must always be in line with the financial gain. In other words, in a year where an entity does not make any financial gain, that is mining oil exploration, then the financial cost will be carried for 5 years consecutively. Are you getting it? In the next 5 years consecutively. But also, where the financial cost is more than the financial gain, listen to this carefully, where the financial cost is more than the financial gain, then the financial cost allowable must be equal to the financial gain for the year. Now, let me rewind the principles because this is very critical. Number one, the principle in mining oil exploration company. Number one, financial cost must be used against financial gain. That's the first principle. Any unused financial cost, number two, can be carried for the next 5 accounting years. Number three, where financial cost is more than the financial gain, the financial cost allowable must be equal to the financial gain. Are you getting the idea? Then, where the financial cost is less than the financial gain, then all the financial cost is allowable. Are you getting the principle? So these are the principles that you've got to understand. If you don't get it, rewind the track and then you will get it there. So what do we mean by that in principle? In principle, what it means is that when it comes to mining and oil exploration companies, what is going to be happening is that, for instance, for a year under consideration, what is going to happen? We're going to have a pro forma. So let me slash in a pro forma here real quick. Now, you know that the entity in practice is going to be lessen the financial cost and then add the financial gain. So when we are preparing their financial statement for tax purposes, we're going to be adjusting their chargeable income. Then we will find out which one will be allowable and which one will be non-allowable. So what do? We bring the profit, report it. We're going to be add back disallowable expenses in the question. Okay, then we're going to also add back any depreciation in the question. All right, then we're going to be lessing allowable expenses. All right, we less that out. And then maybe we can do 2 cash column. Let me do 2 cash column here. So we less allowable expenses. That is if there is any adjustment we need to make. And then capital allowance will be brought. These two will be taken here. When less, we get what is called the adjusted profit. All right. Then the financial cost was added, so we're going to be lessing it back. So we less financial cost. No, the financial cost was subtracted as an expenses, so we are going to be adding it back. Okay, then we add back financial gain, because let me do the right thing. You add the financial costs, and we're going to be lessing the financial gain, because the financial gain was added, so we're going to be lessing it out. So when we less it out, this is what gives us the adjusted chargeable income for the company. Are you following the principle? Now, this will apply whether we are in mining or we are in a traditional companies. So we bring their profit for the year, any disallowable expenses, personal expenses, any capitalized expenses, whatever, it will be disallowed. Any depreciation that they have charged during the year will be disallowed, so we add it back to the profit. Then whatever allowable expenses that they hadn't allowed, we will allow it. Capital allowance traditionally is supposed to be allowed, so we less it, we get the adjusted profit. Then the financial cost was subtracted, so this profit figure reduced. So what do? We add it back. Then the financial gain was added to increase this profit. So what do? We take it out. So after we do this adjustment, that is where we're going to be asking ourselves, how do we practically treat the financial cost and the financial gain? So this is how we go about that. So in a simple language, like I told you in a moment, because we are starting with mining and oil exploration companies, the financial cost will be written off against the financial gains. I getting it? So if this is a mining and oil exploration company that we are dealing with, let's say they incur a financial cost of 10,000. We are in Ghana, so 10,000 Ghana cedis, and they had a financial gain of, say, so that's scenario one, of say 5,000 Ghana cedis. Then the allowable finance cost for the year should be equal to the financial gain. Hence, we will only allow them a financial gain of what? $5,000. Does it make sense? Then the extra $5,000 will be carried forward in the next 5 accounting years. So that is the principle. That's the principle. Scenario 2. Let's say they incur financial cost of $5,000, but they had no financial gain. So financial gain is nil. For mining, oil exploration companies, it means they can't write off any financial cost. For that reason, since the financial gain is nil, they are going to be carrying the financial cost in the next 5 accounting year. So that's the second scenario. Third scenario. Let's say they incur a financial cost of, say, 2,000, and they incur a financial gain of, say, 5,000. Like you can see in the third scenario, you realize that the financial cost is less than the financial gain. For that reason, all the financial cost will be what? Allowable for the tax purposes. All the financial cost will be allowable for tax purposes because it's far less than the financial gain of the organization. This is what you have to understand when it comes to the mining and oil exploration companies. I hope it makes sense. And we've done a lot of this treatment already in the treatment of tax liabilities of companies, but I just wanted to bring your knowledge about it again for you to understand what's happening. Now, the final thing you must understand is that when it comes to the treatment of the financial cost in the subsequent years, this is what happens in the subsequent years. They are written off in the subsequent years in the order in which they occur, which you know about from the treatment of the losses, from the treatment of unutilized capital allowance. So they are treated. So let's say in year 1, they had a financial cost of 2,000 and no financial gain. In year 2, they had a financial cost of 3,000 and no financial gain. And then in year 3, they had a financial cost of 5,000 and financial gain of 10,000. Before we deal with the year 3 issue, we'll come to year 1, write off that cost. We'll go to year 2, write off that cost. Then if there is still some amount of the gain left in the year 3, then we will write it off against what? the year, part of the year 3, then the rest will be carried forward to the next accounting year. So it is written off or used against the financial gain as and when it occurs. So that is what you have to understand about this. Now, so once we compute the financial cost that will be allowed for tax purposes, what do? We simply go in there and go and deduct it in relation to that for us to get a chargeable income for the organization in that case. So that is how we deal with the tax from or finance cost and finance gain in the mining companies and oil exploration. Now, the second slide of the coin is to look at how it is done in traditional companies, okay? In traditional or ordinary companies. So how do we go about that? The principle is the same but quite different. The same in the context that we're going to be calculating the adjusted chargeable income of the organization, right? So we calculate the adjusted chargeable income of the organization. Now, after we calculate the adjusted chargeable income of the organization, the principle for traditional companies is not about letting the financial cost be used against the financial gain. This is how it goes. So let me put the principle down. Give me a moment. Right, so let's go. So this is how the rule applies. Number one, the financial cost allowable must be equal to or is the sum of the financial gain. Okay, the financial cost allowable is the sum of the financial gain plus 50% of adjusted chargeable income. This is the financial cost allowable. Does it make sense? So for traditional companies, the financial cost allowable for an organization or by an organization is equal to the financial gain for the year and 50% of the adjusted chargeable income and 50% of the adjusted chargeable income. So let me give you some principles. So when you do this adjustment, after you do this adjustment, the financial cost that will be allowable will be the financial gain you had for the year and 50% of the adjustable income. Now, so what if during the year you incurred a financial cost but you did not get any financial gain? Listen to me carefully. These are the principles that you must understand. What if during the year we incurred a financial cost but there was no financial gain? Now, in mining and oil exploration, if that thing happens, then we'll just carry the financial cost to the next year. But in traditional or normal companies, that doesn't happen because the rule is the financial gain and 50% of the chargeable income. So if the company incurred a financial cost without any financial gain, then what we will do is that we will still calculate this adjusted profit. That means the financial gain will be nil, 0, but 50% of the adjustable income will be allowed. So in that case, the financial cost will be equal to 50% of the adjusted what? Chargeable income. You get a principle there? So when the company incurs a financial cost without a financial gain, then because we are using this rule, the financial gain is going to be nil, but the financial 50% of the adjusted chargeable income is going to be there. So it means that we will allow that in relation to that. Very, very important. So making sense of this, let's look at a question here from the practice note by the Commissioner General. So let's look at a question here real quick. Go to my slide on that. Okay. Okay, so let's look at this question. So profit for the year is 22,000 Ghana cedis. Depreciation is 7,000. So profit for the year 22,000. The following were included in arriving at the net profit before tax. Depreciation 7,000. General bad debt written off 1,005. Realized loss 2,000. Total financial gain 7,000. Total financial cost 50,000. Chargeable income 12,000. Required. A. Determine the chargeable income after adjusting for financial gain and loss. B. Compute the allowable financial cost. And then C. Compute the tax payable. Compute the tax payables. So that is the requirement of this question. So let's see how we go through. Now please note that this is a traditional company, okay? So it's not a mining or oil exploration. So like you can see from this question, you realize that the company made a profit of 22,000 Ghana cedis, after which, right, 22,000 Ghana cedis, and they had a total gain of 7,000 and a total financial cost of 50,000. Now, so if it was a mining company, then the financial cost allowable here would just be equal to the financial gain, which is 7,000, and then the difference of 43,000 will be carried in the next 5 accounting year and written off in order as and when it occurs. But because it is a traditional company, we need to calculate the adjustable or adjusted chargeable income. Then we take 50% of that and add it to the financial gain, and that is what will be allowable for tax purposes. So let's see how we go about that. So the first thing we do is to adjust what the income for the company. So A, adjusted chargeable income. So let's see how it goes. Gonna have my cash column here. So net profit before tax, that's 22,000, right? So we're gonna be adding back the depreciation like you know already. So the depreciation for the year was 7,000. We added back. Then there was general bad debt of 1,500. You know, general bad debt is not allowed for tax purposes. But if it is a specific bad debt, because bad debt allowable for tax purposes should be a bad debt that the entity has taken various action to recover but is not able to recover it. So general provision for bad debt, it's disallowed for tax purposes. So 1,500 we added back. So that will be 8,500. That will be 30,500. Then we're going to be lessing so we less there is realized loss. Now during the year the company, it means that previous year the company had made a loss and this year they are trying to write off the loss, but that is not how the loss should be treated. All right, the loss will be treated later on. So whatever realized loss will be added, will be taken out in relation to that 2,000. Then that gives us the adjusted profit. $2,000. Hey, did I say 2,000? 28,500. Then we will less capital allowance. You know that already, right? The capital allowance for the year is 12,000. So when we take it out, that gives us the chargeable income. And our chargeable income is going to be this minus this, that'll be 16,500. Then now we can deal with the financial cost and what? The financial gain. So look at how it goes. We add back the financial cost because it was deducted, which is 50,000. And then we will less the financial gain because it was added. And this is going to be, I hope you can still see, 56,500. Then we less the financial gain of 7,000. So when we add it to it, that's going to be 59,500. Okay, because of space, I'm going to write that here. So the adjusted chargeable income is going to be 59,500. So that's the first thing we do in the determination of how we look at the financial cost or financial gain that will be allowed for tax purposes. So you see the various adjustments that we did in relation to that. So now that we've had this in relation to the organization's chargeable income, now we're going to be basing on this to find out how much financial cost we are going to be allowing. So let me put that here. So allowable finance cost. What did we say? We said it should be the financial gain. So my financial gain in the question was 7,000 plus 50% of the adjusted chargeable income. Okay, so we add 50% of this particular figure, 59,500. All right, and that's going to be 29,750. 29,750. So we added 2 up, and that would be 36,750. So this will be the allowable finance cost. I hope it makes sense. This will be the allowable finance cost. Now, but remember the total finance cost the company incurred was what? 50,000. So the difference or the excess finance cost will be carried where? It's not allowed for tax purposes this year, but it will be carried forward for the next what? 5 years of assessment. So the excess is going to be 50,000 minus 36,750, and that's going to be 13,250. So this is carried in the next accounting, the next 5 accounting year in relation to that. I hope you get a concept. Now, like I was saying, like I told you earlier, assuming they have no financial gain, we will still do the calculation, and then that means that only the 29,750 will be allowed for tax purposes. Okay, because we will still go through the principles. Or if we realize that, oh, they have the allowable based on our calculation is less than the financial cost they have incurred, then we will allow all the financial cost in relation to that. In that case, we wouldn't have to adjust their financial statement. We just based on the chargeable income that they had, and then we'll go straight and allowed all the amounts for tax purposes. So now that we have computed the allowable finance cost, which is 36,750, that's what we are interested in. Now let's look at the chargeable income of the organization that we can calculate in relation to that. So let me rub this. It's my duster. Rub this up. Okay, I'm not gonna be cleaning a lot. I'm not gonna be cleaning a lot because I just want to chip in the things here. So the heading here is tax payable. So computation of chargeable income and tax payable. Computation of chargeable income and tax payable. So the profit will be brought, the depreciation added back, general bad debt added back. Then we're going to be adding back as well the finance cost. Okay. So more or less like now we are doing the tax purposes. So we add back the finance cost, financial cost, which is 50,000. All that is added back. Then we sum all of them up. That's going to be 80,500. Remember the first one we did was 3,500. So when we are adding the 50 to it, it becomes 80,500. Then we now less the realized loss. Let me go for 2 cash columns here. 2,000. Then we now bring the allowable finance cost. Okay. Allowable financial cost, which is 36,750. All right, that's what we less. Then we'll get 38,750 here. So we less that from the 80, and that is what we get as the adjusted profit. That's going to be 41,750. Does it make sense? Now, right, we have that. What do? We now less capital allowance. Less capital allowance, which in the question was given as 12,000. And then that now gives us the chargeable income, which is going to be 29,750. So that's the chargeable income for the organization. But we are not done. The examiner said we should also compute the tax liability of the company. So what do? We now compute the tax of the organization. So based on this tax liability, remember at 25%, because we assume this is a traditional company. So 25% off. Remember, if it's a mining, you do 35%. Or if it is a specialized industry or organization with a certain location, then the location rate will be what? Applied in relation to that. So 25% of the 29,750, we get 7,437.5. This is the answer to the question. Does it make sense? So the first adjusted thing we did is for us to get the adjusted profit so that we can know how much of the chargeable income will be allowed for tax purposes. Okay? How much of the chargeable income will be allowed for tax purposes. So after we now do that calculation, then we now come back again to re-prepare this. So you realize that because we are not allowing all the financial cost, we are adding it back. Okay? We are adding it back in relation to that. Like I said, assuming we did the allowable and we realized that all the financial costs must be allowed for tax purposes, then there is no need to add it back and then come and do allowable here. We won't add it back. I get in the concept. We won't add it back because all will be allowed for tax purposes. So it may not come on the face of our preparation in relation to that, because all of them is allowable for tax purposes. So this is what you have to understand about the treatment of financial cost and financial gain. So if you have any questions, you know what to do. Put it in the comment box if you're watching this on YouTube, or you write it down. Then during our Skype one-on-one sessions, you raise it up, and then I can assist you with any questions that you have. But remember the principles very well, because what we see with students is that, yes, you can go through this and understand, but when the question is done a little bit, no, they freak out. But understand the principle and know how to do the various treatments. Thank you for watching, and I'll see you in the next video as we continue with our discussion on principle of taxation. Bye-bye.